Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, October 20th, 5:18 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with The Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important to know for next week, and review the carnage in the world famous 21 over 21 leaders list. Let's get right into it. This is the piano player edition of the Big Show. There's a saying back in the Old West, when they would raid the house of ill repute, they would arrest the piano player as well. And very often leading stocks are referred to as piano players because when the market starts to fade, they hold up. If the market really starts to come apart, the market comes and gets those stocks also, meaning they're the piano players, the last ones to get arrested or break down. And we absolutely saw some of that yesterday, more of that today. We'll get into it when we go through the 21 over 21. But state of the market is moderate correction, meaning we're more than 8% off the highs from late July. Check the trend gauge over here, several downgrades. Leadership from neutral to down. Short term, yesterday we went from neutral to down. Medium term, this actually has been down since 9/21. We've rallied. The NASDAQ 100 was able to get above the 50-day moving average, but it failed back below there again this week. S&P 500 was never able to get back above. Long term, a downgrade from uptrend with the red arrow to neutral as the S&P 500 gave up the 200-day / 40-week moving average today. So joining small, mid, and the Dow, which have been below the 200-day, NASDAQ still quite a bit above the 200-day. So what happened today? Just really weakness all day, mild gap down, and weak rally attempt midday, sold off into the close, closed at the lows of the day, closed below. Several times during the day, we got a back, we battled above and below that 200-day moving average level, which was around 42.33, but it gave it up by the end of the day. Rally officially dead with the undercut of under the 10-6 follow-through day lows in the NASDAQ and the NASDAQ 100. Here are the final numbers. Big 7 hit hard, led to the downside by Tesla, down another 3.7% after the miserable day that it had yesterday after its earnings announcement. So down nearly 2% on the Big 7. Our 8 growth ETF composite down 1.5%, S&P 500 down 1.3, NASDAQ 100 down 1.5, Dow down 0.86, mid caps down 1.1, Russell 2000 small caps down 1.3, global diversified 60/40 stock bond down 0.61%, little pullback in rates, meaning a little bounce in bond prices. Cushion the blow there. In-house GROTECTION down 1.20%. We got stopped out of all of our individual stock positions. We've got some ETFs, and we, with the close below the 200, reduced our index passive exposure too. I'll get into all that when I review the charts and go through the 21 over 21 and tail of the tape. So let's get into it. Let's start off with the Dow here. You can see it got above the 200-day moving average Monday and Tuesday of this week, but a very common candle bar combination over the last 3 days that you're going to see is just down, 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 and started with high gap up in yields on Wednesday, some hawkishness Thursday in Powell's speech, and just follow through to the downside today. Hasn't broken the lows from back in late September, early October. So, and note the relative strength line, which is typical. The Dow loses less when the market pulls back, gains less when the market goes higher. Typically, there are no absolutely always rules on Wall Street. Let me find the weekly charts here. There it is. In the upper right-hand corner here, you can see the last 3 months price action on a weekly chart, as well as what every ticker that we're looking at in the daily panel. You can see what the return was for the week over there. Let's go to the S&P 500. Playing ping pong around the 21-day moving average late last week, early this week, failed into the declining 50-day moving average with a false break above short-term resistance there. And from failed moves come fast moves. I talked about that in this weekend's podcast. And then the familiar 3 days down pattern closing below the 21 by 0.2%, closing below the 40-week moving average by 0.5%. The historical studies that I did quantified a break with a 1% or more move above or below. So although we closed below it, it still doesn't fall into the category when I started gathering stats on breaks of the 200-day moving average that led to bear markets. So kind of like Lloyd Christmas saying, so you're saying there's a chance. We'll see what next week brings, but things are pretty ugly right now. But we are extremely oversold after 3 days down. 3 days down on the NASDAQ 100 also, still 5.1% above the 200-day moving average, hasn't pierced the lows of mid-September. Let's go back to the S&P very quickly. That has 42.16. That has not pierced the lows of late September either. Did undercut the low of the follow-through day, but not the low of 10.3, which was 42.16. Today's low being 42.23. Boy, we're really reaching for positives here, aren't we? And also notice that 4,200 level has a lot of support from the breakout level late May, early June, and the failed rally back at late January that resulted in that last leg down that we saw in February and early March. Let's go to mid caps now. Mid caps making lows below that late September, early October level at 440. Small caps, that also making lower lows there. Lower lows, let's see today's low. Yeah, we're back below the lows even of March. By far the weakest index, just awful looking stuff. And again, the hallmark of a declining trend, you see it a lot in longer trends that fail, just trending below a declining 21-day moving average. One peak poked its head above it earlier this week on a Tuesday. I mean, what a 3 days this has been. We were fairly optimistic on Tuesday, midday after that break above the range, but the range breakout failed and then just absolutely came apart over the last 3 days. We've been reducing exposure and now have the lowest exposure that we've had in an extremely long time. VIX higher highs, keeping in line with lower lows on the S&P. VIX actually a higher high, while the S&P has not quite made that lower low. Above the 20 area, we talked a lot about the VIX in the podcast. Make sure you check that out as well. Let's go to the dollar. Dollar very tight range today. How did that impact gold and gold and silver stocks? Gold broke above 2,000. Closed below it by the end of the day, but still closed positive by 0.27%. You can see this double bottom. And I showed the monthly chart of gold on the podcast and talked a lot about this. 1, 2, 3 failed moves out to new all-time highs. Will the fourth time be a charm? We're referring all the way back to the 2011 highs, where we've spent a little bit of time above those levels, but could not clearly break below before pulling back. A true bull market in a commodity is one that makes all highs, regardless of the currency. And gold has made new highs in all currencies throughout the globe, with the exception of the dollar, because of how strong it is. So, if this is going to be a true gold bull, we'll make a new high there, joining the rest of the world. Right now, we're the cleanest dirty shirt. So there's gold. Let's go to gold stocks. Strong most of the day, but finished off the highs near the lows of the day. Gold stocks just aren't necessarily going to go higher if all stocks are going higher. But as you can tell by the negative close today, but serious relative strength in gold stocks over the last 2 weeks. And silver SLV Closing right on the 200-day moving average, up 1.4%. Let's flip to bonds. Nope, we'll do Bitcoin first. There was a lot of talk about Bitcoin eclipsing the 30,000 level earlier today. Broke BITO, that's the Bitcoin futures, closed above the 200-day moving average, up 2.7%. Let's go to the broad bond index now. Here's the bond pullback in yields, bounce in prices, small bounce up 0.36%. Let's go to TLT, the long bond up 0.6%, slightly off the lows. This means a pullback, slight pullback in yields, TYX, the 30-year. This is not showing hold on a second, 1020. So this is showing a higher high in the yields, even though price was high. I'm a little confused by this. I got to double check this. TNX up slightly also. Bonds close at 3 o'clock. Does that have something to do with it? Maybe it does. But anyway, on the week, bonds yields very clearly making new highs, and we went above the 5% level briefly on Thursday on the 10-year, pulled back intraday yesterday and today. Something is just not quite right with this chart here. This looks like it's showing the candle for the 19th on the 20th and not showing the candle on the 20th. I'm quite certain. All right, let's get to the tail of the tape. You can pause this, hit the highlights. All the stochastics are working against us now. We're inverted again for the second day on the VIX. That means we're living in an extremely risky environment. VIX should not be inverted or backward dated. Normally it's in contango, meaning I showed the VIX central chart on the podcast. I think I showed it last night also. Second close below on the VIX. Day count from 2 down to 3 down, third close below the 80 EMA and the 21 EMA. As far as sectors go, 11 out of 11 sectors down, especially oils and regional banks, several regional banks. Man, these rising yields are just killing their balance sheets. On the upside, gold, silver, gold stocks just barely down, and the dollar up, but just barely higher. Portfolio stopped out on all the rest of our individual positions. Coming into today, they were either a quarter size or third size. Nothing was even as much as a half size. But VRT, Nutanix, Zscaler, Palantir, CrowdStrike, and NVO, Novo Nordisk, all stopped out. We did some offensive selling on DRB. That's the inverse real estate as it was extended near 3 ATR, and trimmed SSO with, I said we normally keep that 50 to 60% position. We cut it from 60 to 50, the equivalent of the S&P 500. So 25% SSO is 50% in the S&P 500. So all we have left is that, our gold, energy, and TBT, which goes up with rates. Bottom line, that cut the beta from 0.79 to 0.53. Came in, got as high as 1.12 on Tuesday, all the way down to 0.53. We've just been doing this long enough that we know we have to respect our stops. But the bottom line now, S&P 500 closed the week below the 200-day moving average and the 40-week moving average, effectively killing the rally. Let's take a look at this chart that if you watched our videos, you're very familiar with. This is our 13 bear market back to even chart. All of these bear markets occur below the 200-day / 40-week moving average. Just because you get below there doesn't mean you're guaranteed to go straight down. There's a lot of chopping back and forth around the 200-day moving average that requires a lot of questions to be asked, but really gauging the weakness, we're looking at the slope of the 100-day, the 150-day, the 200-day, because let's go to a daily chart of the S&P 500 to see when things really got bad in 2022. Let's go back a year. Mentioned this several times. You can see the bouncing up and below the 200-day moving average here from January through early April. Then the last attempt at a rally as the 200-day finally was flattening out, failed on 421, then it rolled over, and that was the beginning of the second leg down, which preceded the third leg down. in the market sell-off, and uh, you'll the slopes of the moving averages on a weekly chart during this period is something we'll be paying close attention to. Here was that approximate time, and you see they just start to roll over one by one. We're paying attention to the 10, the 20, the 30, and the 40 moving average. When they all roll over and get lower, that's when you're completely at risk. So we'll be taking risk off as continuing to take risk off as things deteriorate here, but for now, less than half of uh, exactly half of the market exposure for the S&P, and then still some energy, interest rate, and um, gold holdings in the portfolio. The few things that are holding uh, up. So let's get to the 21 over 21 now, and you'll see the piano player reference really coming into focus here as the last 2 days, really, they came and got them all. There's a little more than 21 here because I make some changes during the week, isolating strength versus weakness. Speaking of strength, TBT, this is one that is really an inverse play, and that's why we're in it. It goes up as interest rates go up. And this continues to just look great, forming a breakout from the cup and handle, continuing to go higher. TBT, tight inside day today. So that's obviously on the 21-21 list, but it's not a growth stock from quite obviously typical standpoint. Now, this is the pattern that we'll be seeing a lot of. So we had several breakouts since the follow through day. A lot of them continued higher. Some of them gaining, maybe 10 or so percent. And then weakness late last week and early this week, particularly starting on Wednesday. And you're going to see this 3 days down pattern. Quite a few leaders held the 21 yesterday or closed just below it, but gave it up today. We've got a handful of them left that are still back above the 21, but a lot of them are commodity type names, coal, uh, and the weight loss drugs, and they don't fit into the typical growth stock that you'll see coming apart with a break below the 21-day moving average. CrowdStrike, another one, one of the few that held the 21 in growth land, so that's still holding up okay. Energy stocks still above the 21. Palantir breaking below, formed a cup and handle, but broke below the 21 now. XLRE, we're in TBT. This is what we got out of TBT today as this got very extended to the downside, so we cashed our gains in that. Novo Nordisk still holding right on the 21, but we stopped out of it due to market weakness. Gold, still holding this, looking good. Again, obviously not a typical growth stock. Duolingo came apart on Thursday. Last week, prefaced what was really to come with a break below the 21. Most of these stocks held the 21 last week. This one undercut, rallied, and then gave it up on Thursday, and now it's down to the 50-day moving average. Textron, defense stock, one of the strongest ones, failed breakout, 3 days down, broke the 21 and the 50-day moving average. Coal stock sitting right on the 21, CEIX. Elastic sitting right on the 21. This got a big upgrade and some nice volume 2 days ago, so this is one that is bucking the trend. Dell breaking the 21, coming into the 50-day / 10-week moving average. Akamai breaking. Bellring Brands still holding up. This is a protein shake company, shakes, powders, nutrition bars. Constellation Energy basically right below the 21. Fabrinet failure. This was one of the early leaders breaking out before the follow-through day even. But look at all that selling, not necessarily on big volume, but you don't get paid on volume, you get paid on price. Breaking the 21. Abercrombie and Fitch holding up nicely. Molina Health holding up. Clearly not a typical growth stock. Zscaler gave it up today on heavy selling. VRT broke the 21 yesterday and the 50 today. Obviously, we got stopped out on that. FNGS, this is the 10 FANG index, breaking the 21 and the 50. General Dynamics still holding above, but pretty much all of these defense stocks now are back inside the body of that first day up. So any follow through we had thoughts of profits with the wars going on, not enough to keep these above their breakout level. A breakout meaning above the high of the initial day up after the day one of the Israel-Gaza um, conflict. SMCI completely broken now. ITA fits in. We're at the lows of the day from this. This is the defense index near the lows of the day of that first move up. And Northrop Grumman still holding up. Northrop Grumman and General Dynamics, CGD. Yeah, I just showed that. That's back inside the body. TXT was the one that really broke down. So that's going to cover everything, and that's going to wrap it. And now we monitor for strength. We monitor for relative strength. Always keeping our watch list updated to see what's working. A lot of headwinds. Market just couldn't overcome them. 3 days down. Wouldn't be surprised if we have a bounce. First close below the 200. This is where risk picks up in moderate correction zone. Let's show our expectations chart and various market conditions that we have here. Mild correction 4 to 8%. Once you pass 8%, get to 8 to 12%, call it a moderate correction. We continue to go down. We'll experience minor outperformance here as our beta is lower than the overall market. So going from this mild correction to moderate correction should be the expectation here. We had a failed follow through day now 2 weeks to the day today. Came out with it and for the most part unscathed, down maybe 1% more than the market, but leaders very clearly broken today. And that's going to wrap it. As always, like to hear from you. Thanks for the likes. They really picked up, by the way. And I've got some comments out there on last night's video I still need to address, but I really appreciate the engagement and liking the video. That really helps get our word out there that you don't have to be a slave to the market. Worst thing ever, and we've experienced this firsthand with family members, is having your money with an advisor with no sell discipline and going into retirement and just losing a substantial piece of your nest egg. And we're about preventing that at Revere. That's why our flagship portfolio is named GROTECTION. Grow during uptrends, protect during downtrends. We're shifted from protection mode 3 weeks ago to growth mode with the follow through day, back to protection mode with the failure of the rally and the break back below the 200-day moving average. And if you like this common sense approach, reach out to me, Don at RevereAsset.com. My partner, Dan Stewart, if you're interested in becoming a client, that's Dan at RevereAsset.com. Phone is 855 Real Wealth. That's 855-732-5932. And with that, I will wrap up the piano player edition of the big show. This is Don Vandenbord with Revere Asset, telling it like it is. It's not how much you make in the market, it's how much of that you can keep, obviously. Gains are nothing if you give them all back. But thanks for listening and have a great weekend.